All right, thank you, everybody. I'd like to now call the meeting of the Senate Finance Committee to order. I want to thank the members of the committee for joining us virtually today, and I also want to thank both Director Thorson and Paul Dion with the Office of Revenue Analysis for joining us today. This is the second hearing of the Senate Finance Committee. The first hearing was very much focused in on the state of our expenditures, the state of federal dollars, responding to the coronavirus relief, and the overall status on the expenditure side of the budget. Tonight, we're going to change focus a little bit and begin to look at the revenue side of the budget. And I want to thank both Director Thorson and Paul Dion for their work to give us an update this evening on where the state's revenue picture stands as we try to get a sense of both the expenditure and revenue side for this current budget year and start looking ahead towards the next budget year. So with that, I want to welcome both the Director and Paul with us today. And Director Thorson, I will turn it over to you.
Thank you, Chairman Pierce. And members of the committee, thank you for having us from the Department of Revenue. It just seems like a few weeks ago that I was before you for confirmation. The good news is that Paul Dion has been with the state for nearly 18 years. And I'm very fortunate to be the director of an agency that has seasoned professionals who have seen a lot and know a lot and are very competent and professional. And it makes it a lot more fun for me to come to work every day and get a chance to work with these folks because they're dedicated and they're knowledgeable. And I think you'll get a sense of that this afternoon. We have had a chance to brief the Lieutenant Governor on some of the material that we're going to present to you today, and have shared some material with the management budget. I wanted to mention that up front. But just a few words about an update on the Department of Revenue. As you know, it's a department that has approximately 600 employees and 6 divisions, including the Division of Taxation, Municipal Finance, Lottery, DMV, Central Collections Unit, and the Office of Revenue Analysis, which Paul Dion, PhD, a longstanding employee, and most of you know, is in charge of. We deal in volume here with over $1.5 million in driver's licenses processed, in over $2.5 million, or approximately $2.5 million of tax filings annually, and about $3.5 billion in fiscal 2020. About 1/3 of the state's annual budget comes through DOR. That means that there's quite a need for analysis. And today, Paul is going to present some analysis on the revenues, including looking at the current revenues as of December, which is about halftime for the fiscal year. He's going to talk about a comparison of Rhode Island relative to our neighboring states, look at some of the impacts of COVID-19 on our revenues and some federal tax law changes included in the coronavirus relief package that have implications on the budget. We're not really going to talk at length about the budget tonight because there's a number of things that that revenue, of course, fits into the budget, but it needs to be placed with the Office of Management and Budget and then briefed to the governor. And we're in kind of a transition time right now. And then we'll close out with revenue trends and projections. Paul, I'm going to turn it over to you. I don't know whether you want folks to wait to the end or to interrupt you with questions. Why don't you go ahead and take it away, Paul?
All right. Thank you very much, Director. Pleasure to be before the Senate Finance Committee. And Happy New Year to everyone. And glad to see that everybody was able to attend. I'm going to share my screen, hopefully successfully. If you just bear with me 1 second so we can walk through the slides. And one more. And hopefully that is viewable for everyone. So obviously this is the Senate Finance Committee. It's our state revenue briefing. Quick outline. There was a quick introduction to the Department of the Revenue that Director Thorson's already done. So we'll skip that slide. And then we're going to proceed through current revenues as of December 2020, a comparison of our revenues on a cash basis to other states, some impacts from the COVID-19 pandemic, some federal tax law changes that we need to be aware of, and then finally revenue trends and projections. It's always my preference to have questions asked at the time so that we don't have to go back to find the slides, but there'll also be time at the end if you are more comfortable in asking and waiting till that point. Okay, so this is the Department of Revenue. It's the org chart, and Director Thorson has already talked about most of these items. I just want to briefly talk about the monthly reports that my office puts out on behalf of the Department of Revenue. One is our monthly and fiscal year-to-date revenue assessment report and some details about how that's prepared. We also do a monthly and fiscal year-to-date cash collections report. The first report, the revenue assessment report, looks at our revenues and compares it to the estimates that are adopted at either the November or May revenue estimating conference or included in the enacted budget. The fiscal and year-to-date cash collections report only looks at cash collections with no adjustments made for accruals, et cetera. Then we do a local 1% meal and beverage tax collections report, shows by municipality, month to month, year over year, and fiscal year to date over fiscal year to date, local 1% meal and beverage tax collections. Companion report is for the local 1% hotel tax collections. And the one thing I would tell you is that particular tax does apply to what we call realtors and homeowners, which is essentially vacation home rentals. And then finally, the state 5% hotel tax collections report, which looks at the state 5% hotel tax, how it's distributed to the tourism districts, municipalities, the Commerce Corporation, and the Providence War Convention and Visitors Bureau. And that particular report does not include realtors and homeowners or vacation rentals, if you will, because they are not the state hotel tax is not applied to those rentals. You can find all of these reports on the Department of Revenue's website at www.dor.ri.gov. And if you click on the revenue analysis link in the state reports tab or the local reports tab, depending on the report, you will find actually many years, probably almost 10 years worth of reports out there. And then for those who participate on Twitter and occasionally follow me, I sometimes post links as well when the reports are released.
Twitter star, Paul.
Quick question.
I'm sorry, yes.
Quick question relative to the 1% meals tax. How often do you distribute that to the local communities?
So that's a good question. So it's distributed monthly on a 2-month lag. So for example, the meals and beverages, that were sold in December, those tax returns are not due until January, probably last week sometime. And then what the revenues from that will then be distributed to the municipalities in February.
Okay, thank you.
The reports that I put out there, though, are for the month of activity. So if you see a report that says December, that means for the sales that occurred in the month of December, not based on the distribution of the revenue.
All right.
You're welcome.
Mr. Chairman, just a quick follow-up, Paul. The only exception is Newport, right?
So Newport's, the only exception for them is on the hotel.
Right.
And that is because they collect their own hotel taxes.
Right.
But we do get those and we do line those up with how the state collects the hotel taxes so that they come out consistently. So again, month of activity, and then it gets paid and then it gets distributed. So we do distribute on the same basis. So there's not a difference between the Newport distribution versus the state distribution. So this slide in front of you is the latest monthly and year-to-date revenue assessment report for December. That was released on Friday, January 22nd. And the major findings of the report are shown in that table. The total general revenues, so keep in mind that the report is going to look at not only taxes, but also departmental receipts, the lottery transfer, other miscellaneous revenues, because those all comprised general revenues to the state. The adjusted revenues were ahead of our expectations by about $58 million, a variance of 3.1%. And I'll talk a little bit more about that in a second. And then just to highlight some of the bigger impacts, you can see the personal income tax, it's about 31.2 million ahead of the estimate, 4.4%. And then within the personal income tax, final payments were way ahead, 55.1%. And there's a reason for that, which I'll talk about shortly. And then withholding payments, which is basically, withholding out of a paycheck, was about 1.7% ahead. The sales and use tax, was 2.1%. And pardon me, I'm just blocked from my being able to read my own slide. Business corporation tax, let's see. Sorry about that. There we go. Sorry. Business corporation tax was 9.5% ahead of the estimate. Departmental receipts were 4.7% ahead, and then the lottery transfer was slightly behind. So relative to the estimates through December, we would show a surplus of $58 million, but I'm going to tell you that that's a soft surplus. There are events in the future that have not been captured by these numbers quite yet that we need to be cognizant of. And some of that has to do with the performance of the economy. For example, most of the impact of the pause from December are not in these numbers. Sales tax is paid 1 month in a 1 month lag, so your December sales tax numbers here are from November, basically. And then there's some issues involving the business corporation tax that we'll talk about here in a minute.
Thanks,
So
Paul.
that's the year to date.
Paul, before you move off that, before you move off that slide, Senator Cano.
Thank you, Chairman. Well, thank you so much for explaining well these numbers to us. My question is in regard to the business corporation tax and personal income tax. And I've been consistent with this question. I do know that it's very difficult to separate the ITIN revenue, the identification tax ID number. But in these numbers, that's reflected, right? That includes the taxes that have been paid through the ITIN numbers.
Correct. It includes, I'm sorry, my fault. I apologize for that. I hit the wrong button. It would include any taxes that have been paid, whether it's been paid through somebody's social security number, their TIN, their FEIN, any tax that we have received on a tax form.
And you might not have the answer to this question, but for the future, will we be able to get a breakdown of which one would be ITIN, this corporation taxes through the system, or the system needs to be upgraded? Or you don't have to have the answer to that question right now, but I just tried to see if you had it.
Yeah. Understood. I would defer to the Division of Taxation on that, and let them answer that when they get a chance.
Sure. Thank you so much. Appreciate it.
You're welcome.
Senator Acosta.
Whoops.
Hey, Doc. Thank you. And yeah, on this slide, you're alluding to what's going to happen in the future. A quick question about the past. How much of this variance is due to extremely conservative estimates going into a pandemic budget, right? So is it really that we collected more than we expected, or that we expected less than we were afraid of expecting more? You understand what I'm saying?
Yes, I do. So these expected revenues are based on the revenue estimates that were included in the enacted budget that was passed in December. And most of those, other than the lottery transfer, most of those revenues were all revised up in total by $330.6 million in the November Revenue Estimating Conference from where they were in May. So I would not, these are the best revenue estimates we have at the time, based on the information we had through October and November. So I don't, this is not a comparison to, for example, the revenue estimates we had back in May, which, albeit at the time, were very conservative, but of course, the future was very unknown and uncertain at that time as well.
All right, thank you, Senator.
So this is the next slide here is the monthly findings of the report. And again, the monthly findings, about 33.5 million above expected revenues for the month of December, a 9% variance. And again, personal income tax is about 8.8 million above. But the real key is if you look at final payments, it's about $25 million more than we expected. So I'm just going to spend a minute on this. If you recall, there was a tax change passed in the state taking effect in tax year 19 that allowed pass-through entities to make income tax payments on behalf of their shareholders. And this provision essentially allowed some tax relief federally outside of the SALT cap. If you remember the state and local tax deduction cap of $10,000 at the federal level. So what's happened is we have transferred those payments from business corporation tax, which is how they come in, into final payments for personal income tax, which is how they are estimated at the revenue estimating conference. And it turned out December was a very substantial month for that, much higher than we would have expected based on last year, when January was a significant month. And it may turn out that we simply received these payments earlier this tax season than we did last tax season. And this number may smooth out when we get to the January report. At least I'm expecting it to smooth out. If it doesn't, then I guess good for us. So I do want to just caution you that that is one of these issues where I say it's kind of soft, is because there may be a time shift between the January payment and December payment. And the way we were expecting the revenues was that they would come in the same pattern as last year, which January had the big number.
And Paul,
sales and use
Paul,
tax was up. I'm sorry?
Sorry, Paul, on these, right? So help me remember and maybe help the committee remember. There was some extensions of deadlines to file and other things that impacted, I think, last year and I think roll into this year. Could you just remind us of those sort of,
Sure.
and how that's shifting maybe their collection trends?
Sure. So those impacts were basically cash impacts, Chairman. So the due date was shifted from April 15th for your tax return to July 15th. And then for estimated payments, the due dates were shifted from April 15th and June 15th to July 15th. So we got a lot of cash in July. But because we're an accrual-based system, we were able to identify the receipts that we received in July that were above the normal for a July, and those were accrued back into fiscal 20. So they are not, those types of, that transaction is not in these numbers. We have already taken into account the amount of monies that we received in July that were already accounted for in FY 2020, and I took them out of these numbers.
Okay, great. Senator Palmer.
Thank you, Chairman. Paul, just going back to the answer you provided to Senator Cox on the comparison. So when we say expected revenues, expected is based is what? Is expected? Go ahead, sorry.
Sure. So their expected revenues calculated, there's a methodology we use, we talk about it in the report, of what we expect to collect in a particular month based on the average over the 5 or 10 previous fiscal years, depending on what the revenue source is.
Okay, let me be more specific, Paul, then. Thank you for that. Is it tied to the FY21 budget? Is it tied to the November estimated? What's it tied to?
It is tied to the FY 2021 enacted budget, which included revenue estimates adopted at the November revenue estimate conference.
Okay.
And an $18 million reduction in revenue for the lottery transfer.
No, okay. So at a macro level, the $33 million at the top, the 9% to the positive for the state, let's say, is over and above what was included in the FY 2021, not 20, the FY 21 budget of which we're now operating in.
Correct. That was enacted on December 18th.
Thank you, Paul. Thank you, Chairman.
Thank you, Senator.
Okay, so again, sales and use tax has been strong all the way through. We'll talk more about that in a minute. Business corporation tax up again. I'll talk about that in a second as well. Departmental receipts up about $3 million, and that's been mildly volatile. And then finally, the lottery transfer down about less than $1 million. Keep in mind, the lottery transfer numbers are for gaming activity in November, so they do not include the pause that occurred in December, where the casinos were closed from November 30th to December 20th. So one day of the pause is in this estimate of the lottery transfer. So I just wanted to give you a quick look at how are we doing relative to other states in the Northeast. So this is cash. The prior two slides were revenues, so they're not 100% comparable. And I just want to caution you on that. Obviously, Rhode Island is over here, the far right, second column in from Vermont there, the first column in from Vermont. But you can see we're relatively consistent with most of our states, neighboring states. In particular, you'll see the business corporation growth percentages are pretty strong. Massachusetts at 51.7%. We're in the 40s. The one exception I would point out is that we have seemed to have done better in sales and use tax than most of our neighboring states in the Northeast, with Vermont being an exception here. Keep in mind that there's different tax rates in every one of these states. There's different tax bases that are subject to the tax, and categorizations of receipts by each state can differ. So one state may include something in business corporation tax and another doesn't. But generally, you can see we're in line and maybe even doing slightly better than most of the other states in the Northeast, given those incredibly strong caveats. Let's talk a little bit about sort of the revenue impacts of COVID-19. So what I wanted to do is I wanted to spend a few minutes talking about economically what has been the impact of the COVID-19 pandemic on our economy. The dashed line you see there is set to 1.0. So what I did is I took our employment data and I set the base to be January of 20 for every series. The blue line you see on the bottom is total non-farm employment. That's essentially the entire economy. And the other sectors you see on the graph are sectors that have outperformed total non-farm employment, but again, not necessarily above where they were in January. So they have, all these sectors have been hit by the COVID-19 pandemic, and some have been hit harder than others. But all of these sectors, which includes educational services, government, financial activities, manufacturing, and construction, have all done better than our total non-farm employment. So as you recall, when we went into our shutdown, for lack of a better term, in this spring, certain sectors were not subject to that. For example, manufacturing, construction. So they have been able to weather the pandemic somewhat better. The spike you see in educational services, of course, is in August, which is a normal return to school at the time, and would include not only K through 12, it includes the colleges and universities, not K through 12. They show up under government. And then, so these are the sectors that I call them overperforming, but when I say overperforming, I mean relative to the economy as a whole, not relative to where they were in January. Of course, we also have some sectors that are fairly close to how the economy's performed as a whole. And, these would be retail trade, and retail trade does include remote sellers and also professional and business services, which tends to be a lot, lawyers, accountants, engineers, economists, et cetera. And they have performed pretty similar to how the state's economy is done as a whole. And then finally, we have the underperforming sectors, if you will. No surprises here. Again, the dashed line is geared to January as the base. Now the top blue line is the total non-farm employment, and each of the sectors shown there has performed below the economy as a whole. And these include arts, entertainment, and recreation, accommodations and food services, and then other services.
Paul, for each...
And the COVID-19 impact has been not spread evenly across all sectors of the economy. I'm sorry, I didn't mean to cut you off.
No, absolutely no. No, that totally makes sense. For each of the sectors, do we, have an estimation, and this is more of a follow-up probably, but do we have an estimation as to what percent each sector makes up of, one, the labor force, two, the overall sort of economic output? Be interesting to see kind of how that breaks out between, what percent of our economy basically is, overperforming the trend, what's on, and then what's below.
Yeah, I can get that for you, Senator. I'm just taking a note here. I should be able to get that for you.
Okay. Thank you so much.
You bet.
Senator Palma.
Mr. Chairman, Paul, just a question on the comparison. You have one pegged at January. Could we look at it? I would not say it would be better. Could we look at the same data of the year prior? But given some of the sectors you're talking about, I would expect them to be probably down in some areas and go down after some other areas. But would be worthwhile to look at it from the perspective of same time period, as opposed to January being the one.
Yeah, so absolutely can do that. Senator, I do have some revenue slides coming up that actually do exactly what you're looking for. I wanted to really sort of highlight the impact of the pandemic. And, January was actually the first month when a case was found nationally, as I recall. May turn out that it was really earlier than that, but they hadn't identified it. I believe the first case was in Washington State. That's why I chose that. We could go back farther if you wanted. Maybe the slides coming up will answer your questions about that.
I apologize.
No, just let me know and I'll do that.
But not to go back far, but the 1.0 was set in January. Should 1.0 really be set somewhere other than January as a date for?
No, I understand what you're saying.
Okay, thank you.
I understand what you're saying. Okay.
And Paul, on that same chart on slide 12 there, the other services, what's generally included in other services? Seems like they had a bit of a recovery and then are going back off the cliff there.
So it is kind of a grab bag, to be honest with you, but it's generally what we call personal services for households. So dry cleaning, hairdressers, gyms, although they can end up in recreation too. But generally, you think about personal services to households is the best way to describe it.
Okay, thank you.
By the way, Senator, to be clear, some of that may be a seasonal thing. I mean, the data is seasonally adjusted, but you do still see seasonal changes in the data.
Makes sense. Okay, thank you.
So the next slide starts to look at the revenues. So this is a slide of revenues that have done well, even with the impact of COVID-19. And Senator DePalma, to your point, this goes back to January of 19. So these data points are not seasonally adjusted. They're just the raw data points. But one of the things I wanted to show was, and this is through October of 2020, which is the most recent data that includes meal and beverage and hotel tax collections. So you can see this is the sales and use tax without motor vehicle use tax receipts, no meal and beverage sales tax receipts, and no hotel sales tax receipts. And what you see and what I pointed out there in those arrows is the difference in the June sales activity is pretty remarkable given that we're in a pandemic. So you can see the drop off in March and April, and then the bounce back in June. Obviously in March, April, and May, we were effectively, we had a stay-at-home order and were primarily shut down. But you can see that the sales and use tax has rallied tremendously from that point. If you look at the 2 Junes, and although it's come down a little bit since then, it still has remained elevated relative to the prior year. So, why is that? Well, a lot of this has to do with the stimulus. People were receiving, what do they call them, recovery rebates of $1,200 a person. So a family of 4, I thought the total was like $3,400, as I recall. And those monies were available for consumption purposes. We, in my opinion, wisely expanded our sales tax base after the Wayfair decision to cover remote taxable goods that are sold online or by remote sellers. And we saw a fairly large shift in consumption from brick and mortar retail operations into online purchases. And we were able to collect the sales tax on those items. And some of this is due to the unemployment compensation enhancements that were passed under the CARES Act, including, I think, one of the most important ones, which is the pandemic unemployment assistance, which basically made unemployment available to individuals and workers who are not normally covered by unemployment insurance. We call them gig workers or some self-employed.
So Paul.
Yes, I'm sorry.
No, it's okay. So when taking a look at this, right, I think 2 questions emerge, right? There appears to be some normal, or I should say, normal reoccurring trend line in January that we typically see a pop in this line in January of each year, and then it stabilizes for the year. Do we know what that generally is? Is it January receipts representing December holiday spending, or?
Exactly.
Okay.
It's exactly what it is.
Okay. And then
So that's why you see that big spike in January of 20.
yeah, you see it every year. Yeah.
Yeah, it's basically your holiday spending, because remember, those returns for December activity are not filed until January.
That's right. Okay. And then looking at this through, I think that, the other bottom line, taking a look at this, right, is that by the time June came around, our June, or maybe that's July, our receipts were back at almost holiday levels then.
Correct.
And, they've fallen off, but I mean, they're still remaining at an elevated level. So, I mean, excluding those segments of the economy that have been sort of deteriorated, I mean, we're seeing more consumer spending in the Rhode Island economy in 2020 than we would have probably expected driving most of this, right? Am I interpreting that correctly?
Yeah, so I just, we probably would have had some growth anyway,
Yep.
just to be clear here. It's significantly higher, and some of that was pent-up demand. Because we were at stay-at-home orders, you do very little in that mid-March through May period. And then as a result, after that, when the economy opened up again, obviously in a phased manner, rightfully so in my view, you had a bunch of pent-up demand. Simultaneously, there was a significant amount of federal stimulus that became available through those recovery rebates I talked about. Also, the enhanced unemployment, $600 a week, also started to become available at this point in time. And the combination of sort of pent-up demand and the enhanced financial resources of households led to a strong, a surge, if you will, in spending, including spending on items that are subject to our sales tax.
Okay.
If you look to the right, you'll see the motor vehicle use tax receipts in the orange there. And effectively what you've seen, there's a lot of, as you can see, there's a lot of volatility in that stream. But what we really saw is that the big dip there is, again, the shutdown, and motor vehicle, car dealers were affected by that. And then we saw this big surge after that. And again, that was people who couldn't buy a car before, but also with the fiscal stimulus, the federal stimulus, people all of a sudden had a chunk of cash they could use for a down payment on a car to purchase a motor vehicle that they may not have been able to do before. And you saw that big jump in June, and then, it dips a little bit in July, but it always dips in July. Most people are not buying cars in July, they're at the beach. And then it starts to rise again with some of the additional unemployment compensation payments, et cetera. So these are like the two areas that we've really seen have more than weathered the COVID-19 impact. Basically, supported by those stimulus numbers. Supported by those stimulus numbers. So the next slide looks at sort of the revenues that have been recovering. They took a dip and they recovered, and so I did move these into. I use these as quarters this time, and the reason I did that is because the business corporation tax net estimated payments are made on a quarterly basis, and if I just did it on a monthly basis, it basically looks like somebody's having a really bad EKG, and the lines are bounce up and down all over the place. So I wanted to sort of give you an idea of, what it would look like on the quarterly basis so we could smooth some of that out. You can see on the left is personal income tax withholding, and it's usually a little bit higher in the first quarter of the year. That is because the first quarter of the year, in particular March, tends to be when corporate bonuses are paid out. And so you see that spike in the middle of the graph there and at the very beginning of the graph. But you can look at if you look at the slopes of the line, if you will, it's fairly gradual in 2019, much sharper in 2020 as we go into the second quarter because of the stay-at-home order. It kind of flattens out and then it starts to pick up again, and we're basically back close to where we were, at least nominally, back in 2019 Q1. Similarly, for the business corporation tax estimated payments, you saw there's a spike in essentially Q2 because estimated payments are due at that time, and then we saw a fairly large drop early in Q1, mostly because of the situation as it was unfolding in March, looked very dire. We've had a pretty strong rally since, and almost every state has seen this, and we're now up to a level that we were basically in 2019 Q2.
You could even argue a little bit higher than 2019 Q2 at this point.
Correct.
Yeah.
I always like to be conservative, Chairman.
We appreciate that when you're doing the November revenue estimating, not May.
So the next slide, and this is hello, come on. There you go. So the next slide just focuses on meals and beverages and hotels. And you can see on the left, whoops, I'm sorry. Keep doing that, keep hitting the wrong darn button. You can see on the left the meal and beverage slide. And I just tried to focus on summer because that's usually a big time of year for us for that. So that's the local 1% meal and beverage tax. You can see it typically dips in the spring, so the February and March, and then it starts to rise over the course of the second quarter of the year, peaks about in the summer. Usually we don't get those receipts until around September, October. Then it tends to decline over the winter and then come back up. But you can see this year that we still have not reached where we were in the summer of 2019. So we're below that peak by a decent amount. On the hotel tax and the other slide there, very similar but more deep has been the dive. Again, you see the peak there in September 19 is usually August receipts, We obviously rose in September, but we're well below the peak from the prior year. And these are clear impacts, I think, from the pandemic, which has had an adverse effect, particularly on travel, as well as restricted hours, for example, from accommodation, from food service, restrictions on bars, et cetera, has held back spending in those areas, and it's going to be some time before those recover.
Senator Acosta.
Doc, thanks. I have a question on this. Some of the that we've been using funding has been trying to use hotels to house people and things of that nature. So when we provide either subsidies or funding to some of these industries, are those streams taxable for them?
So I'll give you a general. Typically, if depending on how this is structured, of course, if an entity that is not subject to the tax rents a room, they typically do not have to pay the tax. So usually governments are not subject to the sales tax. So if the government, for example, rents a room in a hotel on behalf of someone, those rooms would not be subject to the hotel tax. If I, as an individual who work for the government and travel, even if it's on government business, I rent a hotel room, then I do end up paying hotel tax. But if the entity itself is not a taxable entity in general, a nonprofit, for example, or the government, then they would generally not have to pay the taxes on a room rental. Typically, you have to have some sort of sales tax exemption on file with the Division of Taxation for that to be the case.
All right, that's helpful, and I think that's going to lead to some follow-up questions, not to you, to some of the service providers during some of these responses. Thank you.
You're welcome.
Thank you, Senator. Senator DePalma.
Thank you, Chairman. Paul, the y-axis on both of these are, is it dollars or not?
Yeah, I'm sorry. I apologize, Senator. I forgot to put the dollar on there. That's my fault. Those are dollars. I apologize.
No, I just expected, I guess, the hotel tax to be higher than, in the month of September, higher than $700,000 of August of 19.
So that's just 1%? That's just a 1% tax?
Okay.
That's not the sales tax.
I got it. Looking at it, I'm saying, knowing what just down in the Newport area, what hotel rooms are, and you got to have 3 nights. It's like that. Okay, thank you.
Multiply that by 7 and you'll get the sales tax impact.
Okay, it sounds good. I was going to say, we'll put another 0 on the end of that. Thank you.
Senator DePalma may need help with that multiplication, but
I don't think so.
Thank you, Chairman.
To be better with theory.
that's right.
Absolutely. It counts for us, the area under the curve.
All right. So let's, I'm going to go to the next slide if that's okay. I do want to talk a little bit about the, what I call the coronavirus relief package. You may have heard of it as the Consolidated Appropriations Act, but effectively it's that bill that was attached to the continuing resolutions federally to provide some relief, some additional relief under coronavirus. And to really talk, what I really want to focus on here is the Paycheck Protection Program loans. Now, those are a CARES Act initiative. So they were made available to small businesses in tax year 2020. So they could continue to pay payroll, other expenses in the face of the pandemic. And in the definition was the federal definition of a small business, which is important, I think, because we would not think maybe one of these businesses as being small, but it has to be a non-public company, so it can't be on a stock exchange. And it could not have more than 500 employees. Now, I know 500 employees is a lot in Rhode Island, but nationally that's considered to be anything 500 and less is a small business. If the proceeds from a PPP loan were spent according to federal requirements, then the PPP loan would be forgiven And the requirements, they changed a little bit over time. I think initially they were 70 or 75% on payroll and the rest on other expenses, but those were modified later to be 60% on payroll and 40% on other eligible expenses such as rent, utilities, I think even inventory is allowable. IRS regulations have long stipulated that a forgiven loan, which is technically referred to as cancellation of debt, has to be recognized as income in the tax year in which the loan is forgiven. So when the debt is canceled, because the loan is forgiven, you typically have to recognize that debt cancellation as income for tax purposes. The CARES Act, however, had a provision in it that literally says PPP loan forgiveness is tax-exempt income. So even though that's a long-standing IRS regulation, the law passed under the CARES Act declared PPP, the debt cancellation associated with a PPP loan to be tax-exempt income. IRS regulations also have held that expenses paid for with tax-exempt income cannot be deducted against other taxable income sources. So if you have tax-exempt income to cover expenses, you can't then deduct those expenses against, say, revenue that would be subject to tax. The coronavirus, in August of 2020, the IRS issued guidance saying that the qualified expenses paid for with a forgiven PPP loan could not be deducted from other taxable income. And that was consistent with IRS regulations that have been around for decades. The coronavirus relief package, as I like to call it, again, that rider that was included in the continuing authorization, appropriations authorization at the federal level, signed into law on December 27th of 2020, nullified this IRS guidance with respect to forgiven PPP loans. So basically, the expenses that you pay with a forgiven PPP loan, again, tax-exempt income, could be deducted against other taxable income sources. And this is a one-off. It only applies to the PPP loan. So one effect of this change in the tax treatment of these expenses, the deductibility of these expenses, is to provide what they call a double benefit to taxpayers. They pay for it with tax-exempt income, and they can then deduct it against taxable income sources. So I tried to illustrate, and hopefully it's going to be clear, how this works. This is a very simplified example. I just want everybody to understand that. So no PPP loan, just looking at three items: gross sales, total expenses, and net income. In normal tax year 2020, whatever that means, but no pandemic, let's put it that way, I have $100 of gross sales, I have $90 of total expenses, and my net income is $10. And then I would be subject to tax on that $10. Under the pandemic, no PPP loans in place. The pandemic, just for by assumption, reduces my sales by 50%. I proportionately reduce my business expenses by 50%, right, as a way to maintain my business. My business net income decreases to $5. So everything's down effectively 50% in this simplified example. So when the business reduces its expenses, particularly its variable expenses, because labor is the easiest one, they lay off workers, and that increases unemployment. And the PPP loan was designed to avoid that, to not make an unemployment situation even worse. So the PPP loan is made available, and the business can retain the workforce and not add to unemployment. And that was the intent. Sorry. There you go. So the PPP loan is made available to the business, and now we get to under the CARES Act and under the IRS August 2020 guidance, and we get to the first column. That green column you see there is just a repeat of the green column from the prior slide. So if we had no PPP loan, that's what it would look like. With the PPP loan and the IRS guidance, My gross sales still dropped by 50%, but I can now pay for all of my expenses. Let's just assume they're all eligible expenses too, with the PPP loan. But I can't deduct those expenses because they're being paid for with tax-exempt income. So now my net income, instead of being $5, is now $50. I'm assuming you have no other expenses to deduct, just to keep it simple. So you see this, a sharp increase in this particular example in the net income, and that would imply higher tax bill for a business that participated in a PPP loan. And the accounting industry in particular, as well as businesses, argued that this was a, quote, surprise tax that results from the structure of that program. So the coronavirus relief package passes. It nullifies that IRS regulation regarding the deductions. And now we see the circumstance in the box. Again, the purple box there is just a repeat from the prior slide. The gray box, I tried to make it gray at least, now shows you what happens with this under the coronavirus relief package. Again, my revenues have dropped by the 50%. I can now deduct my expenses that I paid with the PPP loan against my other taxable income, which is my other revenue. And in this case, business net income decreases. I happen to be showing a loss here. It could decrease to another, a smaller positive number, could decrease to zero. I just want to emphasize it decreases. And that lowers the tax bill.
So, Paul, I think the point...
Example, just 1 second, Chairman, just so I can finish this one point.
Yeah.
In this particular example, if you have a loss of $40, your tax liability would actually be zero, because you don't about a negative amount. I'm sorry, go ahead, Chairman.
No, I think the point you're trying to make, Paul, is I'm just connecting your beginning scenario. This business owner started off with a net income of $10, and they paid income tax on that $10 of income, right? So
correct.
Their take home would have been somewhat less than that 10. In the scenario that we're getting to all the way at the end here, cash in pocket, right, to the business owner here is $50, but they're claiming a $40 loss to the IRS, so income tax liability zero, and if nothing else, carry forward the loss.
Correct.
Net, this federal change is putting this business owner in a far better position financially, not even just because of taxes, but because of everything, than they would have otherwise been in. No pandemic.
So that is probably, somewhat because I have a very simple example here.
Right.
So I'm not going to tell you that that's going to be true in every single case. It's true under the example I provided to you, but certainly theoretically, I would agree with you there, yes.
Yeah.
They've been in a better position than potentially they would have been otherwise.
Right. And it all depends on what the size of the PPP loan was, how much of their expenses were they able to cover, what were their real business revenues. I mean, there's a lot of
Correct.
other examples there, but the illustration that you're making that I think is important is that the benefit of this PPP transaction and the way it's being treated from a federal taxation perspective is significantly increasing the after-tax benefit for the entity that received the PPP loan.
I don't want to say significantly, I would say it definitely improves their circumstances.
Okay.
Because it's all going to depend on the, who the business is.
Yep, and all the factors we talked about, for sure.
So anyway, so this is a very simple example, and I just happened to show a loss just to, one of the things I did want to sort of have you think about is that there could be loss carry forwards coming down the road here. So the next, I'm sorry, I always hit that wrong darn one. So the next slide then talks a little bit about, so how does this impact Rhode Island taxes? Our personal income tax and our business corporation tax, which is our corporate income tax, we automatically conform to these federal tax law changes. And these federal tax law changes affect federal adjusted gross income, which is what impacts our personal income tax, and federal taxable income, which is what affects our business corporation tax. So remember, the business corporation tax is paid by C Corps, and personal income tax, your pass-through entities, S corps, LLCs, partnerships, sole proprietorships, et cetera, they all pay through the personal income tax. So the change to the deductibility of the expenses impacts business net income. That's a component of federal AGI and a component of federal taxable income, depending on how your business is structured. Federal AGI is the starting point for our personal income tax. Federal taxable income is the starting point for Rhode Island's business corporation tax. And decreases in federal AGI and/or federal taxable income reduce our personal income tax and/or our business corporation tax revenues. So this is just a quick, so these forms are a little old, but I wanted to illustrate a point here. On the left, you can see this is the federal 1040 from, I think, 2015. Our personal income tax starts at that arrow down there at the bottom. And you can see there are approximately 28 or so items that feed into that bottom line number that we operate off of. Every one of those lines you see above there are lines that the federal government can tinker with that will impact our federal AGI. And believe me, there's, as you all know, there are other schedules that support certain entries over there. On the right-hand side is the business corporation tax form, and this is for C Corps. And we start with line 28, and all the lines above that would be lines that can be impacted by federal tax law changes. So you can see there's a lot of room in there for federal changes to impact Rhode Island starting points for our own tax systems. So just to bear with me, I'm sorry. So the timing of the change in the deductibility of these expenses was such, because it didn't occur until December, that they're not included in the November 2020 rec estimates. So what does that mean? So the CARES Act resulted in about $521.5 billion of PPP loans being made nationwide in tax year 2020. 1.904 billion of these loans were made to 17,875 Rhode Island businesses and nonprofits. 192.9 million in the PPP loans were made to tax-exempt nonprofit entities, at least as they identified themselves. 1.711 billion was made to for-profit taxable entities. If all the 1.711 billion of PPP loans, let's just assume everybody on their PPP loan application properly identified themselves, are forgiven, and the 1.711 billion of expenses paid with the loans are deducted against other taxable income, the impact on state revenues in tax year 2020 or FY 2021, by my estimate, is in the tens of millions of dollars. And when I say tens of millions here, I don't mean 15. I mean closer to the 100. So it may even be more than 100. A lot of that estimate depends on apportionment factors, effective tax rates, and items like that are not easy to determine with the data we have available to us. The data we have available to us is very limited.
And Paul, I just want to connect that point. So when we started off in the beginning, on slide 7, right, we started off with year to date, right, through December, so half the fiscal year, running, in theory, a $58 million potential surplus, again, given all the other parameters that could come into
Correct.
that. But, assuming that was a solid number, we haven't, in this chart, we have not connected the PPP impact you're talking about here, which could be $100 million or more, very quickly negating out that early read of a potential surplus.
Certainly a possibility, Chairman.
Okay.
The situation with the PPP loans is that some of the forgiveness has already occurred, but a vast, I think it's over 90%, are still seeking the forgiveness of the loans right now. As you know, those tax returns are being prepared right now and won't be filed until March 15th or April 15th, depending on, primarily until April 15th. And could have an impact on final payments. We usually get about 70% of our final payments in April, and could impact our corporate tax collections also in April, so we haven't seen those yet. And again, my estimates are based on actual data, but the data is sparse. I'm not going to deny that.
And, I think we're probably looking at, are you looking at actual filer data to come up with that? You're looking at more the overall, there was 1.7 billion that went to taxable entities and assuming some average rate or?
So I took the data from the SBA for every borrower in Rhode Island.
Yeah.
And so I have the data for every single borrower. And there's a category that allows you to identify yourself as a C Corp, a nonprofit,
Yeah.
a partnership, a sole proprietor, et cetera. I eliminated everybody who put down nonprofit, assuming they did it correctly. And I don't know if that's true.
Okay.
And then I separated the C Corps from everybody else because C Corps is the only one who are going to pay the business corporation tax. And I looked at those numbers and said, well, our business corporation tax rate is 7%. But of course, there's apportionment. So those C Corps would apportion some of this income to other states where they do business. Similar for the partnerships, LLCs, S Corps, kind of thing. I used effective tax rate of approximately 3.5% on the personal income tax side. But of course, some of that stuff will be apportioned to other states. The flip side is companies in other states that took loans apportion money to us as well. And I don't know what those apportionment factors are, so I just said, I'm going to assume that the Rhode Island entities, 100% of their costs and whatnot are apportioned to Rhode Island. Just to, in my own mind, figure out what might be, a worst case scenario. It's not clear to me it's a worst case scenario, but at least would cover us to the extent until we get better information maybe on the apportionment factors, if that's even possible.
Okay. And you really, your timeline to get clarity on this, is it really just a march towards the April filing deadline that will give us clarity at least for the last calendar year?
So it's going to be one of these situations where you look backwards to say what the impacts are.
Yeah.
And it's not an easy look back, I might add. There's thousands of returns involved here. Think about a pass-through entity that could have, 70 shareholders. And, you have to trace it through to the 70 shareholders. So we're talking tens of thousands of returns likely.
Yeah.
That's not an easy lift.
And I think it would end up being, the end result of the personal and business tax filings, you'd get it, obviously, if they're filing in April, they're going to do that. But is it more sensing a change in any quarterly estimated payments that might be made?
Yeah.
Maybe sensing it.
Yeah, I'm going to talk about that in 1 second.
Okay.
In the future, because I do think that's an important point.
Okay.
Yes, I'm sorry. Go ahead, Director.
Mr. Chair, I just wanted to mention that that this is not just a Rhode Island problem, it's a nationwide problem. That's the first thing. So we have been talking to some of our colleagues elsewhere, and we're convinced that the methodology that Paul is using is pretty sound. So while there may be some challenges with the data directionally, we have a high degree of confidence that these numbers are, we might be off by 10%, but we're not off by 50%.
Okay. And so we're thinking it's 100-ish. Is that a fair?
Well, a little bit less under the methodology that I used. So probably, within 10 or 20 million of that number.
Okay.
But it's definitely toward the 100 million, not toward the 10 million.
Yeah, so this is the material impact on the budget. So we're working on finding this and getting more information.
Okay.
And just, Chairman, to one of your earlier points, this is just looking strictly at the PPP loans data that I have. I showed you an example where there's a loss carry forward.
Right.
Could impact the next year.
Right. Yeah.
Right? So, this is just, we're talking about tax year 2020 that's already passed us. And those returns are starting to be filed now or in the next month or so.
And you could have a double impact, right?
Possibility
You could
there's going to
have-
be further downstream implications to the extent there are loss carryforwards that result from this federal tax law change.
And you could have a double impact, right? So you could have the carry forward potentially plus a new PPP loan issued in this calendar year that would manifest itself
Correct.
in the following
That,
collection,
that's
right?
that's
So-
the next slide.
Yeah, okay, great. So when does
Well,
the
the
news,
next-
when does the news get better, Paul?
Well, that's a good question. There is some things we can be optimistic about, I think. So the coronavirus relief package authorized the second round of PPP loans in tax year 2021, which is the current tax year. Again, non-public companies, in this case, though, they restricted it, you couldn't have more than 300, no more than 300 employees. You had to already have gotten a first round PPP loan and used all those proceeds properly. And you have to demonstrate that you had a 25% drop in gross receipts in either the first, second, or third quarters of 2020, calendar 2020, versus the same quarter in 2019. So it's not as expansive as the original PPP loans, but still is available and I'm sure will be taken by those businesses that need it. The total amount of second round PPP loans that were authorized federally is about $284 billion. I used our actual data from the first round to just try to extrapolate or project what the potential impact of a second round PPP loans could be for us in tax year 2021. Again, those returns would be filed in FY 2022. So I estimate about 1.037 billion of PPP loans to Rhode Island businesses and nonprofits, about 105.1 million to nonprofits, 932 million to for-profit taxable entities. And as you can imagine, spin the wheel again and you get very similar results, right? You end up with about 932 million of second round loans that could be forgiven. You'd have the expenses paid with the loans that could be deducted. And again, you're hitting another tens of millions of dollars impact, less than you had in tax year 2020, which is fiscal 2021, but not insignificant. And that shows up in fiscal 2022. And again, Chairman, to your earlier point, this does not incorporate loss carryforwards or anything like that, that again can reverberate even beyond tax year 2021. So there's two rounds of PPP loans that we're talking about here that spread over a couple fiscal year, a couple tax years, a couple fiscal years, that could have serious impacts on state revenues. On top of that, there are other federal tax law changes that are included in the coronavirus relief package that can also affect Rhode Island tax revenues. I'll just give you one example. There is in the CARES Act, I believe, there was put in an above the line charitable contribution. And when I say above the line, just bear with me 1 second. I'm talking about this area of your 1040. So here's the line they're talking about, right there at the bottom. This would allow individuals and taxpayers who do not file with itemized deductions federally to take a deduction for charitable contributions of up to, well, it was in tax year 2020, it was $300 per return. In tax year 2021, it's $300 for individual filers and $600 for joint filers. So those deductions will again reduce federal AGI, which will reduce Rhode Island personal income tax revenues. I haven't had a chance to look at this yet. I will point out to you that the original above the line charitable contribution deduction was in the CARES Act and therefore was incorporated into the revenue estimates in November. It's just this enhanced piece, which allows joint filers to have a $600 deduction instead of $300 deduction that would impact state revenues in tax year 21 or fiscal 2022. There's some revenue loss here. It's going to be significantly less than in the case of those PPP loans, maybe even less than I think it's going to be less than 10 million. But I don't know for sure. I actually have to run the numbers, and I haven't had a chance to do as thorough a job as I want to do at this point. And then we're looking at some other tax changes in there that may impact us as well. So one thing I do want to talk, I mean, I pause here for a second, Chairman, in case there are any questions about this. It's a lot of information and can be
Yeah, while you're
confusing.
there's basically 6,000 pages of tax legislation that passed that is currently under review by our tax division, Nina Savage and her team. And they are in the process of culling through that and finding out what some of these provisions will impact beyond what Paul just pointed out.
Okay. Any questions from the committee at this point?
Chairman, I have a question.
Senator Felix.
Paul, relative to individual filers, the stimulus check that they receive, is that taxable or not?
It is not taxable at the federal level, so it will not show up in federal AGI.
But the unemployment that they received would be taxable, correct?
Correct. That is taxable at the federal level as part of your AGI, and that does flow through to our personal income taxes.
So that stimulus amount that anyone received that was under 75,000, that is not a taxable income.
Yes, correct. It doesn't show up in federal taxable income.
Thank you.
I mean, sorry, federal AGI, I apologize, because that's on the tax side.
Correct. Thank you.
So the late passage of the coronavirus relief package, so that passed on December 27th. And prior to that, you keep in mind, right, that the IRS guidance was you cannot deduct the expenses you paid for with the PPP loan that's forgiven. And we require you to make your estimated payment on or before December 15th. And this would include both personal income tax as well as corporate income tax. And it may be the case that due to the uncertainty, and in order to avoid interest and penalties for underpayment, businesses made estimated payments to us. And this would include those pass-through entity payments I talked about way at the beginning. That reflected the law that was in place at the time, which would not allow the deduction of these expenses. Now that you can deduct the expenses, I've gone through that little exercise. You can see what happens to your net income, which is subject to tax. There's a chance here that they've overpaid relative to what their actual tax liability is going to be now that they have the deductibility of these PPP loan expenses available to them. So that can result in either higher refunds come March, April period, even into May, or lower estimated / final payments being realized in March to June essentially. So a lot of estimated, we did see a surge in estimated payments in December. They could be related to how the PPP loan law was being interpreted. And now that the new law has passed, nullifying that IRS guidance, they may be overpaid on their 2020 tax liability, and we may be seeing large refunds or large carry forward payments in the coming months. Another piece, of course, that's important here is that there's an 11-week extension of the pandemic emergency unemployment compensation, which includes both the pandemic unemployment assistance and the federal pandemic unemployment assistance. So that's the $300 supplemental payments for those who are on unemployment. So that's a positive. And although we had built in I believe there was a second round of stimulus built into the forecast used at the November conference. I believe that stimulus was approximately this number, the $300 I'm talking about here. So that should provide additional support to personal income tax withholding in particular, and final payments, personal income tax final payments in tax year 21 or FY 2022. There we go.
And Paul, right where you
Direct payment, I'm sorry.
while you're there, let me jump in for a couple questions from committee members. Senator Seveny.
Thanks. So Paul, the impression I'm getting here is that there's a fairly large range of deviation in your estimating, given what actually happens with how these federal programs and the tax implications all really roll out. So I guess my question, I don't even know if it's answerable at this point, but when we get to the May conference, how volatile coming out of that are the estimates going to be? So do you expect a range of deviation to decrease over the next 3 months so you have a better idea of what people are actually doing with their taxes?
So unfortunately, Senator, that's going to be one of those things we're not going to know until pretty well after the fact. As my understanding of the law now is that the governor's budget, when it's submitted on March 11th, I think it is, it has to be consistent with current law. This is now the current law, and presumably, although I will defer to OMB on this issue, the impacts of these changes should be incorporated in the governor's budget submission. Do I think they'll be realized by May, or like known for a fact in the amount by May? Probably not. Again, lots of returns, complicated returns at times. It will take some time before we can go through and examine what the actual impacts were. And I don't think it's realistic to think that could be done by the May conference to know what the real impacts are.
So there's, I guess I have to know at some point how you would assess the risk putting together a budget for July 1st on the basis of such unknowns coming out of the.
So you will have some more data, obviously, on final payments, for example, for personal income tax, as well as estimated payments for corporate tax and final payments for corporate tax. So you will know some of those receipts. And presumably those receipts are going to reflect some of the behaviors I've talked about in this presentation. So you will have some idea, but to be able to tie it specifically to, excuse me, the PPP loan program in the amounts that I'm estimating is not likely for May conference. We process 650,000 tax returns on the personal side, and that's a lot. Obviously a lot of returns, and it takes time to go through them to analyze exactly what the impacts are. But you will see in the data whether final payments are lower than we thought they would be, whether estimated payments are lower than we thought they would be. By the time you get to May, and that data is always incorporated into the estimates.
Okay. Thanks.
You're welcome.
Senator Felag.
Are ready to roll?
You're good.
Every time I try to unmute, I get muted by the so it's a little game that's been playing back and forth. I guess my question, which is probably the $1 million question, Paul, is the federal government or our Congress and senators aware of this? And will the care package provided to the state of Rhode Island take this into account to provide us for that loss of revenue?
So, as you know, at this time, I know the Federation of Tax Administrators does lobby on Capitol Hill and make congressmen and senators aware, Congress people, I should say, and senators aware of these implications. As you know, there has not been a passage of a state and local revenue relief from the COVID-19 pandemic. I can't speak for President Biden, obviously. There's been some indications that I read in the media that there may be something like that coming forward, and those types of relief from the federal government could be used to offset these revenue shortfalls. But at this point in time, to my knowledge, the president has not even proposed a state and local revenue decline relief package. I'm not saying that they won't. I'm not saying it wouldn't pass, because to Director Thorson's point, this is impacting states all over the country, red and blue.
Well, exactly, and that's what I'm trying to get to, is the fact that initially when the PPP came out and it was that 75 to 25
Correct.
distribution, then all of a sudden 5 weeks into the program, they say, oh, we can change it to 60 to 40.
Correct.
And then we'll extend it to the end of the year rather than the 8-week expenditure allotment. It really created havoc within the business community, because most of the people had already spent their money within the 60% within that 5 to 6 week time frame. And so now that they're allowing the business to have this entity, which is, I believe, is well deserved, especially for those businesses that are below the, threshold of 50% or now 25% being the threshold, they deserve that. But by the same token, the federal government has to come forth and provide that differential to the states to make up for that lost revenue. And that's it.
For me, no argument from me here, I can tell you that. I mean, obviously states are impacted differently depending on how they conform to the federal tax code, but all states are going to have some impact at some level. I don't think it's avoidable.
But I guess the question becomes is, how much is Rhode Island reaching out to our own representation as the senators and congressmen to let them know of this potential problem, so that they can bring that forth to Washington and help secure that. Again, this is not a blue and a red thing. It's every state is going to encounter the same problem.
Yeah, I can't speak to that. I'm sure that Senators Reid, Whitehouse, and Representatives Cicilline and Langevin are watching this right now, so now they're well informed.
And Paul, I think
That's a joke.
Paul, I think that actually it brings up an interesting question for us, right? And so, as we're evaluating the impact of this federal change, the state certainly has the option to decouple from the federal returns for this purpose, and to basically have Rhode Island treat the taxation in a different manner, I believe. Help me out there. And then, so I guess my question would be, as we're determining the impact to this, are we also running scenarios on sort of different decoupling options that may be available?
Yes. Can I step in here?
Sure.
Mr. Chairman, I think that that is a different presentation. Respectfully, I think we need to identify the problem, quantify the problem, and then we need to work on solutions. That is, personally, I think that's very astute observation. But we want to make sure that our director of taxation is involved in the discussion of identifying a change in tax code. And this is something that we also have some homework to do between now and the next time we talk about this, and that is talking with our peer colleagues in other states. We have had a number of initial conversations, and we want to make sure that we do a lot more homework before we come back and start making recommendations like that.
Yeah, Director, I appreciate you broke up a little bit there, but I think I heard your point. I guess what my ask, I think, is not that those options be presented tonight. I certainly don't expect you to have them this evening. I guess my question was more, my assumption is that as we're doing the analysis to figure out the impact, I'm assuming the Department of Revenue is also coming up with options available to us if we wanted to make a decoupling decision at some point in the future. Is that fair?
Absolutely, yes, and we intend to share that with you.
Okay, great. Thank you.
Okay, so if it's okay, Chairman, I'll just go to the next slide at this point.
That is good.
So this gets back to something Senator Felag I mentioned earlier. Here I go again. I keep hitting the darn buttons wrong. Pardon me. Sorry about that. The direct payments to the individuals, the $600 stimulus checks, are structured as really advanced federal income tax credits, which is just like the CARES Act recovery rebates. So because they are tax credits, advanced tax credits, they don't show up in AGI, and they're not going to impact our personal income tax revenues positively, if you would. But, obviously the money in hand is good to support our sales and use tax revenues when these items are spent, when this money is spent on taxable items. So it's clearly helpful, even though it won't impact our personal income tax collections. So the enacted budget did reduce the lottery transfer by about $18 million, mostly to account for the fact that the casinos were going to have to be closed during the pause. It may turn out that this was a little bit of a rich reduction. So there might be some money that can come back there. That, of course, assumes that the Twin River or Tiverton are not closed again. So there may be some potential there in the future regarding the lottery transfer revenues. But time will tell. We'll have to see how they perform over the next 4 or 5 months. I will tell you that the January reports are going to show December gaming activity. So they're going to be good because we just had 2 huge jackpots for Mega Millions and Powerball. And so that aspect is probably going to be up. But the casino revenues will be down because of the pause and the closure of the facilities during that time period. So that's pretty much, I did want to talk a little bit about this because this is something we need to be aware of, and it's a little uncertain in my mind. But some of the grants that have been made to businesses in the state as part of either Restore RI, the Hotels, Arts, and Tourism Program, the Rhode Island on Pause Program, the Relief Fund for Restaurants and Bars. Generally, those types of grants are considered taxable income for federal and state income tax purposes. And once they're considered taxable income for federal purposes, it flows through to the state. And obviously, that tax treatment is different from PPP loan forgiveness. And that may give rise to an equity issue for businesses that receive grants rather than businesses that receive PPP loans. It's just something to be aware of. I'm not 100% sure what we could do about it. And it's not clear to me that it's potentially, there's some potential language in the coronavirus relief package that might indicate that these grants could be tax exempt, but I'm not convinced of that either way at this point. But it's something to be aware of, that normally grants are considered to be taxable income at the federal level, and then that flows through to us at the state level. And again, to the director's point, there's numerous other tax law changes in the coronavirus relief package, and we have looked at them, and we are going over them with taxation to determine which ones might impact state revenues. Some of them won't, because they're changes to federal credits that we don't recognize anyway. But we need to really drill down to make sure that there isn't anything lingering in there that would surprise us negatively going forward. I always feel like I have one other thing I was going to say, but then I forget. But I would, here's some quick contact information for myself, the director, Grimaldi, who's our Chief Information and Public Relations Officer, and then Nina Savage, who is the Tax Administrator. And then any other questions, I'd be happy to answer at this time. And otherwise, thank you very much for your time and your attention.
Thank you, Paul. One other question that I think has come up a couple times, and I just wanted to get the sense for what you guys know. Related to the remote worker issue that's been sort of bandied about around the potential of employees that maybe previously had lived and worked in New York, but are now living in Rhode Island and remotely working in New York. Any information there as far as what you may be aware of or what you're hearing or seeing on that topic?
So this has come up a couple times. I'm sure you're aware of the New Hampshire lawsuit against Massachusetts.
Yes.
This is just strictly my personal opinion. I think it's going to be very difficult to argue that someone who works for a firm located out of state is now really working in state, mostly because of, where's the employer tax being paid for that individual? So for example, just think of unemployment insurance. And I have not heard a very good answer to this yet. This question I've asked a couple times. I'm in Rhode Island now, and I work for a New York company remotely. And that New York company pays unemployment insurance taxes. And those unemployment insurance taxes, let's just for argument's sake, are being paid to New York. I think we'd be very hard pressed to argue that individual is a Rhode Island-based employee. There's other factors, obviously. If they, for example, change their address, their voting, their motor vehicle registrations and licenses, et cetera, then they become a Rhode Island resident at that point. And of course, as a Rhode Island resident, they'd be subject to income tax. I just don't know. I've read a couple articles about this New Hampshire, Massachusetts lawsuit, and at least the articles I've read, which hopefully isn't just confirmation bias on my part, indicate that they don't think New Hampshire's got a chance to win that. So that's my guess, is that it's going to, a person is laid off, that individual would collect unemployment from New York, much like if I'm a Rhode Island resident who works in Massachusetts and I get laid off, I don't collect Rhode Island unemployment insurance, I collect Massachusetts unemployment insurance. So I don't know how that hurdle gets overcome when the argument is, where is that employee really located?
Okay, fair enough. Senator DePalma.
Thank you, Chairman. Paul, thank you, and Director, thank you. Just to follow up on that, Paul, what I've seen from a corporate perspective, I think it may change subsequent to where we are in the pandemic now, but I think they're going to go back and talk about homeroom, or wherever your homeroom from a work perspective was prior to the pandemic. And if you're still working for that same company, everything will remain consistent after. We'll see what happens in that regard. But like you said, if you gotta get with the good comes the bad. So if you take piece of it, you're going to get the whole thing coming your way. So I guess it remains to be seen what happens from the going forward on workers and what their homeroom was before, and they worked on site somewhere, and where they're working now. I guess as we move forward, is there help that you need, or from a revenue perspective of, obviously you gave us a comprehensive look at what's in front of us, what might be in front of us, what's behind us a little bit. What should we be planning for going forward?
So that reminds me of one thing, Senator. I do want to point out a positive that I should have mentioned earlier. We are probably in a situation here where household balance sheets are in the best shape they've been in quite a while. This is not the Great Recession. We do not have thousands of mortgages underwater or anything like that. We don't have to wait for households to fix their balance sheets before they can start consuming again. So I do think that's a strong positive. Obviously, the real estate market has been very strong, not just here, although it's been very strong here, but in other states as well. So lots of home equity has increased for a lot of consumers, and it's allowed them to refinance, free up cash for other purposes. And I still think that's going to be a positive going forward. I believe Fed Chairman Powell the other day indicated, look, we're not changing anything right now at the Fed. pretty much going to keep credit as loose as possible because it's needed. And I think that's an important upside to all of this that we've talked about today. The interesting part to me, Senator, would be if there's another coronavirus relief package, for lack of a better term. I know we've heard this discussion about raising the $600 to $2,000. So adding an additional $1,400. If there are other tax law changes in that package, that's something we would have to be alert for. Obviously, if there's state and local revenue reduction relief or whatever you want to call it, that would be a positive for us. That's where I would be concerned is, okay, what is the next, what does the next relief package look like? Please stop helping us. You're killing us. You know what I mean?
So, Paul,
Some of those changes can really hurt us.
so thank you. I guess the one comment I'll just make with regard to, right, this isn't the Great Recession. There isn't an issue of housing. In fact, it's just the opposite. The costs are going up, not astronomically, quite a bit. Stuff is on the market for an extremely short period of time. So while there's a whole bunch of folks that have done well during this period, it's just the other extreme for a whole bunch of folks. They've done it even, they've been impacted even worse because of the situation we're under. So it's I think that's part of a balance we have to have as well.
Well, the other thing we have to be concerned about is any resurgence of the strain, how fast we can get the vaccines out. These are things that I'm sure are at the top of the agenda, and everything else sort of falls out from that.
Thank you. Thank you, Chairman.
Thank you, Senator. Thank you, Paul and Director. Any other questions of the committee?
Hey, I'd just like to ask one quick one, Mr. Chairman, if I can.
Senator Seveny.
Paul, I listened in on that economic forum that Bryant
Yes.
sponsored last week. You guys came across pretty bullish on the recovery. You're feeling pretty good that we're gonna come out of this more quickly than perhaps Dr. Harrington there from Drexel seemed to think.
So I do, and so Senator, as you know, when we were talking on that call, the vaccine is crucial.
Yes.
How quickly can you get vaccinated? But at the point in time where we have enough vaccinations to, engender herd immunity, for lack of a better term, I think you're going to see a pretty strong recovery. Again, a lot of that has to do with household balance sheets are in very good shape. There's been a strong wealth effect from the rising stock market. People look at their 401ks hopefully only once a quarter, not every day, and they go, "Wow, I'm doing pretty well here." So I am still bullish on what I'll call sort of the intermediate term. Still going to be rough, I think, in the very near term. But as we get out maybe into the fall of next year and there's sufficient vaccines and they're effective against all the variants of the virus, which is a huge unknown to me, I think we'll see a robust rebound that will eventually dissipate, obviously, when the pent-up demand is gone and obviously the stimulus will be gone by then, et cetera. But yes, I'm still bullish on the sort of intermediate term recovery from this. If we were in a situation with lots of mortgages underwater, et cetera, I'd be much more pessimistic.
Okay, fair enough. Thank you.
You're welcome.
Thanks, Mr. Chairman.
Thank you, Senator. Any other questions from committee members? Okay. Hearing none. Paul, thank you so much for the detailed walkthrough. Director, as well, thank you for your time this evening. I know this certainly has helped me, and I hope the committee, with getting a good sense of where the revenues stand today, where some of our risks are, where some of the opportunities are, that I think will help us move forward both on a supplemental and on a full fiscal 2022 budget. So we're looking forward to continuing that work, and we will be working with you very closely in the coming months. So thank you again for your time this evening.
Thank you very much, Chairman.
Thank you. And with that, members of the committee, I'd be entertain a motion.
So moved.
Motion to adjourn by Senator Thomas, second by Senator Seveny. All in favor?
Aye.
We are adjourned. Thank you, everyone.